All right, let's dive right in. Today, we're taking a close look at two really popular S&P 500 income funds, GPIX and SPYI. Now, they're both trying to do a similar thing, but as you're about to see, the way they go about it, well, they're worlds apart.
And that's the big question, isn't it? You've got two funds, both pulling from the S&P 500, both cutting you a check every month, so why, when you look at the yield, do they look so incredibly different? That's the puzzle we're going to solve today.
You see, at the heart of it all is this. While both funds are trying to generate income from America's 500 biggest companies, their core philosophies, what they prioritize, and how they get the job done are just completely different.
So let's get to know them. In one corner, you've got GPIX, coming from Goldman Sachs, and in the other, SPYI, from Neo's Investments. Both are built to give you cash flow, but their mission statements, well, that gives us our first big clue about what makes them tick.
And this just lays it out perfectly, doesn't it? Just look at the words they use. GPX is all about balance. It's current income plus capital appreciation. SPI, on the other hand, it's laser-focused. It's about high monthly income and doing it in a tax-efficient way. This is your classic matchup, the all-rounder versus the specialist.
So how do they actually do it? To really get why the results are so different, we've got to look at the engine inside each of these funds. So let's pop the hood and see how the machinery works. Okay, so GPIX uses something called a dynamic overwrite. The easiest way to think about this is like a dimmer switch for income. Every single month, the managers look at the market and decide how much of the portfolio to write calls on, somewhere between 25 and 75%. If they want to generate more income, they dial it up. If they think the market's got room to run and they want more growth, they dial it back down. It's all about being flexible.
Now, SPYI, that's a totally different animal. It uses a very structured strategy called a net credit call spread on the S&P index itself. This isn't a dimmer switch. This is a powerful income engine that's just built to run at full throttle all the time. The entire design is engineered from the ground up to produce high, consistent cash flow, month in and month out.
And this slide right here really lays that trade-off bare. GPIX is all about adapting. It's trying to balance getting you income today with participating in the market's growth tomorrow. SPYI has one primary mission: print the biggest possible income check it can, right now. Look, neither one is right or wrong. They're just different tools for very different jobs.
But you know there's no free lunch in investing, right? All that income comes at a price. And we can see that price when we look at three really crucial things: fees, taxes, and of course, long-term growth.
And this is so important. Fees are one of the very few things in the investing world you have total control over, and they are a direct, guaranteed drag on your returns. So how do our two funds stack up here?
For SPYI, the annual expense ratio is 0.68%. What that means is for every $10,000 you have invested, you're paying $68 a year just to own the fund.
And then you look at GPIX. The net expense ratio here is just 0.29%. That is less than half of what SPY costs. We're talking about a difference of $39 for every 10 grand, every single year.
Now that little gap, that 0.39%, it might not sound like a huge deal. But here's the thing about investing. Over 10, 20, or 30 years, the magic of compounding turns that tiny little gap into a massive chasm in your total return. It's a quiet but really powerful advantage for GPX. Okay, so on fees, it's a pretty clear win for GPIX. But now we have to talk about taxes. And this, right here, is where the specific engineering of SPY really comes into play and gives it a huge advantage, but only in certain situations.
This table tells such an interesting story. See, because SPI uses options on the SPX index, its gains get this special tax treatment. It's called Section 1256. It basically means 60% of the gains are taxed at the lower long-term rate, no matter how long you've held them. Even better, a huge chunk of its monthly payout can be classified as return of capital. That means you don't pay tax on it this year at all. Now, for someone investing in a regular brokerage account, this is a massive deal. GPX, on the other hand, is way less tax efficient, which really makes it a better fit for an IRA or a 401k where all those tax differences don't even matter.
And that brings us to the final and maybe the most important trade-off of all. When you sell options to create income, you're basically selling off some of your potential future gains. The price for that guaranteed check today is putting a cap on your potential upside tomorrow.
Think about it like this.
Because SPYI's income engine is always running full blast, it almost always puts a ceiling on how much you can make when the market is really soaring. You get that great check, for sure, but you might miss out on the big home runs. GPIX, with that flexible dimmer switch, is specifically designed to try and capture the majority of the S&P 500's returns by dialing back the option strategy, which helps preserve more of that growth potential when the market is hot.
So after looking at everything, the strategies, the fees, the taxes, the trade-offs, how in the world do you choose which one is right? Well, it all comes down to what you're trying to accomplish. You've got to align the fund's mission with your personal goals.
Let's start with SPY. This fund is probably your guy if your number one goal, with a bullet, is getting the biggest possible monthly check, period. It's especially powerful if you're investing in a regular taxable account where its tax tricks are a huge benefit. And you have to be okay with the fact that you are explicitly trading away some of that future growth for more cash in your pocket today.
Now, on the flip side, you might be a GPIX person if what you're really looking for is balance. You want that solid monthly income, but you don't want to completely give up on capturing most of the market's growth. If you understand how much fees can eat into your returns over the long haul, that lower expense ratio is really appealing. And it's pretty much the clear choice if you're investing inside a tax-sheltered account like an IRA, where all of SPY's tax advantages just disappear.
At the end of the day, that's really what this all boils down to. Are you trying to get the highest possible check in your hand this month? Or are you playing a longer game, looking for that sweet spot, that balance between income today and growth for all your tomorrows? There's no single right answer for everyone, but now you know exactly how they work, so you can make the right choice for you.